Right. Good morning. We are on the record in case number 2025-00332, electronic application of Navitas Kentucky LLC for an alternative rate filing. I'm Angie Hatton. I'm chair of the Kentucky Public Service Commission. Joining me today are Commissioners Mary Pat Regan and Andrew Woods. And if you have cellular telephones, please set them on silent or turn them off at this time. Hearing today is for the purpose of taking evidence in this matter, and at this time, let's have appearance of counsel for the applicant.
Yes, good morning, Madam Chair. My name is Evan Buckley with Dinsmore and Scholl. I'm joined by Thomas Hartline, the relief on behalf of the applicant, and move it in this matter.
Okay. Good morning. And for commission staff.
Mariah Tussey and Ashley Hatcher.
Good morning. I'm told that public notice has been given and filed in the record.
It has, Your Honor.
Okay. We did notice that there was an issue with the notice. It seems that it did not meet the 14-day requirement set out in 807 KAR 5076 Section 12. However, the commission on its own motion will agree to grant a deviation from the requirement. This is a rare occurrence, but these are sort of exigent circumstances and an emergency petition. So, is that correct, staff?
Yes.
Okay, so we'll issue an order to that effect, but we'll grant a deviation in this case.
Thank you, Madam Chair.
There are also outstanding confidentiality motions, I believe.
Yes.
Okay, we will get those dealt with shortly. I don't see anyone in the courtroom who's here for public comment, but I'll give that opportunity just in case. Is there anyone in the courtroom today who came for the purpose of giving public comment? I don't see anyone. I will note for the record that if anyone is watching and does desire to give public comment, you may do so by sending an email to psc.comment@ky.gov. And let the record show that instructions and link to provide public comments have been posted on the website for at least the past day. All right. Is there anything further before we begin taking evidence?
That I'm aware of.
All right. Counsel, you may call your first witness.
Thank you, Madam Chair. As you know, we're here this morning on a motion. It's a little bit different than a typical hearing, but we have moved under KRS 278-190 for emergency interim rate relief during dependency of this ARF filing. Police's Commission, I'd like to begin briefly by just providing a little bit of background, kind of more in a motion setting like you might see, and just give a little bit of...
Not really an opening statement, just arguing your motion. Okay.
Basically at the outset, I'd like to express our appreciation for the opportunity to be heard this morning. Obviously, the Commission has a full docket. This time of year in particular, we just appreciate the opportunity to be here and to discuss this emergency rate relief we're seeking. I'd also like to thank Commission staff, who's been very communicative and cooperative, both in this case and in the other matter. You may recall we were here a few months ago with this utility. I believe yesterday, Commission staff has submitted a stipulation and settlement agreement in that case that has been signed by staff and the utility that will hopefully resolve that case in a manner that is productive for both the utility and its customers. And we definitely appreciate the communication that has kind of occurred since we were here last on that matter. So as I said, we're here on a motion under KRS 278-190. Before I delve into that, and I'll be brief, but just a little bit of background. Navitas filed an ARF case last summer. I think it was end of July, early August. Ultimately, that rate relief was denied by the Commission for a variety of reasons. There were some incongruencies, perhaps is the word, between the 2023 annual report and the requested rate relief. The Commission expressed some concerns with the rate design and allocation of costs. Ultimately, the Commission entered an order denying any rate relief, and that would have been in March. We filed for rehearing, and an order on rehearing was issued in May. In that order on rehearing, the Commission specifically acknowledged that there is no impediment to an additional ARF filing as soon as practicable, basically, because of Navitas's financial issues. The Commission also encouraged basically as appropriate, a motion that we filed here now in connection with this case, seeking emergency rate relief, and specifically cited the statute and said, if Navitas feels it's necessary, it can ask for this type of relief, and that's what we've done in connection with this case, which was filed in October of this year. KRS 278-190, as you are likely aware, contemplates a suspension period in connection with rate cases. It provides, perhaps not something the Commission deals with on a daily basis, but does allow a utility to request that the rates that it's proposed be implemented early before the conclusion of the rate case. We've just filed, we've done one relatively brief round of data requests in this case, but certainly there's more to be done in connection with this ART filing. However, we have requested, due to the financial situation at Navitas, which you may recall we discussed at some length in the prior hearing, in which Mr. Hartline is prepared to discuss further today and is discussed in the verified motion, is dire. The Commission, the Navitas's financial situation is problematic for continued operations. The standard under the statute is emergency relief can be granted if the operations or credit of the utility may be materially impaired by waiting. And here we feel that if we are to wait until after the winter season into middle of next year before we have a final order and new rates are implemented, that will significantly and materially jeopardize the utility's operations and its ability to continue to serve roughly 700 Eastern Kentucky customers. There's a number of reasons why Navitas's financial condition is what it is, and obviously we discussed some of that in the motion, and Mr. Hartline is prepared to discuss that today. One of those being that certain of the rates in place now have been in place for over 4 decades in Clinton County. Other rates are roughly a decade old. They have not sought increases regularly. Navitas kind of has come to be by acquiring other small utilities in Eastern Kentucky. We're talking Floyd, Johnson, and Clinton County. And there's just really not been a need for a while to increase rates, but it became apparent at least last year, and really it's only gotten worse since then, to increase those rates. And so, with the rates being stagnant for so long, costs of course have gone up, and really it's facing a lot of heat, for lack of a better word, from its vendors, from its gas suppliers, from its lenders, to make sure that it can get rate relief. Especially with the last rate case going the way it did, I think everybody's kind of got their eye on the regulator and hoping that we can, I guess, convince you, for lack of a better word, that we need this relief immediately, and rather than wait until the end of the rate case. I will also note that the emergency rate relief is relatively modest in comparison to the full rate request that is being made in this case. It's only less than 20% of the revenue that the revenue requirement would indicate is appropriate for this utility. So we're not seeking to immediately implement the full rate that we're requesting. It's really just a kind of a stopgap, modest measure to ensure that throughout the next several months the utility can survive until more notable rate relief is issued, hopefully at the end of this case. Like I said, Mr. Hartline's here to discuss and answer any questions that you have and the staff has. I think that he has also verified the motion that has been filed in connection with this relief we're requesting. Like I said, the relief is probably not typical in that not a lot of utilities from our research have come in and requested this relief. It's certainly not unheard of, though. It's happened a number of times in the past several years, 2021, 2019, usually with smaller utilities. And the Commission noted in those cases that small utilities in particular, these types of falls can significantly impact their operations. They're not able to go out to the market and get additional credit like a larger utility. They don't have investors to call upon repeatedly to get funds flowing to the utility. So I think that the relief here is unusual perhaps, but it's also designed for the situation when a utility is really kind of up against it and needs help. just for the interim. And like I said, I think the risk is low that ultimately rate relief will be coming that surpasses what's being requested here. So I don't think the customers face too much risk in terms of, refund. I mean, we're certainly prepared to implement them subject to refund, but the idea that there's some significant risk by implementing this modest measure in the interim, I think, is not founded under the facts. I'm happy to answer any questions prior to calling Mr. Hartline. If there are none, I'm happy to call him as the first and only witness for
Yeah.
Navitas.
I think we're ready for the witness.
Thank you, Madam Chair. Navitas calls Mr. Thomas Hartline, President of Utility.
Mr. Hartline, would you raise your right hand to be sworn? Do you swear or affirm the testimony you're about to give is true and correct under penalty of perjury?
I do.
Thanks. Please be seated. Tell us your full name and your business address, please.
Thomas Eben Hartline, 3186D Airway Avenue, Costa Mesa, California, 92626.
Okay. Counsel.
Madam Chair. Mr. Hartline, what is your position with Navitas?
I'm the president of Navitas Utility Corporation.
And did you verify the motion that is at issue here this morning?
I did.
And how would you describe the current financial condition of Navitas?
It's precarious. That's probably the proper way to say it. It's also unsustainable. But I will say it has been somewhat improving. We have, we went through a rate case in another jurisdiction, and those rates have gone into effect, and that has improved our situation. But we have no financial reserves remaining. And the other thing that we have essentially used up is all of our goodwill with our vendors. And that is, beginning to be a real problem.
Speaking of that issue, your vendors, your lenders, are you feeling that they've reached the end of their ropes with you, I guess, for lack of a better phrase?
Yes, so our two main gas suppliers, Mr. Varner and I had to put in $750,000 in order to pay our two main gas suppliers, which had given us a deadline of October 1st to substantially pay down some of our past gas costs, and we were able to do that. But they have expressed reservations even still about continuing forward, and essentially are drawing down our credit. And then also, even yourself, not yourself, but your firm has been concerned about payment of invoices and such, and that's very typical for all of our vendors, is getting timely payment.
If the relief requested today is not awarded, will that materially impact your ability to continue operations through the middle of next year?
There's three things that are at issue here. We do need the money. I mean, it's not a tremendous amount of money, but we do need it, and it certainly helps. There's also we're very concerned and are always concerned about what winter brings. So, like I always go back to, in 2012, there was no winter. And at this point, we have no reserves. And if there is no winter, we have huge problems. But I think the biggest thing that the emergency rate relief does is it allows me to go to the bank and go to my vendors and say, look, the trajectory is correct. We're putting this back on the right path. And it allows them to have faith in us. I always say that utilities move at a glacial pace, and by design, things don't change very quickly. It takes time to get into a bad situation, but then it also takes time to get out of a bad situation. And we need to show people that here are the things that are happening to take us out of that bad situation, but it will take time.
Do you believe your vendors are paying attention to these proceedings?
I know one vendor called me yesterday and said he would be watching today. So, yes, they are very much paying attention.
Will, if the requested relief is issued, will Navitas begin to earn a profit based on those increased rates?
No, we will not be earning a profit in Kentucky.
About how much revenue do you anticipate will result if the requested relief is issued?
The calculations show that it'll generate $137,000 annually. The rate filing, I think is something like $900,000 increase is in the rate filing. But the emergency rates would generate $137,000 of that, some $900,000. And most revenue is generated in the winter. So that's January, February, March usage is when most of that revenue is going to be generated.
Why haven't you asked for more in emergency rates?
We're very concerned. We're always concerned about rate shock. We are as our history shows, we're somewhat reticent to do rate cases because of the rate shock that they bring in. And that was a specific notation in the denial. And so in the new filing, we've divided the rate increase over, including the emergency, over 10 phases, and it occurs over 9 years. And so we think that will, dramatically reduce rate shock. But specifically, one of the things that we did is when we were looking at the phasing in of the rates, for Floyd and Johnson County, where the bulk of our residential customers are, we wanted to limit the rate increase to 9.9% or less. And that's how we came up with the number that the tariffs which generate the $137,000.
Thank you, Mr. Hartline. I turn to the witness for cross-examination.
Okay, staff?
Thank you. Mr. Hartline, my name is Mariah Tessie, and I'm going to ask you a few questions today, and I'd like to start with a description of your daily operations generally here in Kentucky. If there's a question that I ask that you don't know what I'm asking or you can't hear me, just let me know and I will attempt to re-ask it. So the information filed with the application indicates that Navitas, Kentucky doesn't have any employees itself. But according to some of the other information filed, there are employees that appear to be associated or affiliated with Kentucky Services. So can you talk a little bit about what a daily, work week might look like here in Kentucky for them?
Sure. So just to be clear, the individual utilities in each of the jurisdictions, none of them have employees. We have an operating company called Navitas Utility Corporation, which all the employees are in that one company. All the rolling stock is in that one company, and all the meters are also in that one company. The pipeline assets are in, and what we call the right to serve is in the utility in the state. The reason we do this is because we don't want to have, we're in 4 states, but we're very small. We only have about 40 employees and 5,000 customers. And so we don't want to have multiple organizations that each have an employee and so on and so forth. So here in Kentucky, we have Jimmy Lawson, who is in the, he's in eastern Kentucky. And then he takes care of all of Floyd County and Johnson County. Up until recently, we had a second individual in that location, and I anticipate that at some point in the near future, we will have another second employee in Kentucky. We also have a gentleman, his name is Steve Jolly, and Steve is the general superintendent of the name of the city escapes me. It's a town that has a gas system right across in Tennessee, and he serves our Clinton County system. So he reads the meters, and he does line locates and things like that. Then we also have a contractor that works for us on a regular basis. His name's Tim Hull. And so if we're doing a new meter set, or we're doing a line repair, or we're doing a line extension, generally speaking, it's going to be Tim Hull and his operations. We also have another gentleman who works in Jellicoe, Tennessee, which, as you know, is right on the border. In fact, we have that interesting situation in Whately County where we have a handful of customers who are in Kentucky but are under the jurisdiction of the Tennessee Regulatory Commission. And he's available in the event that he might need to come and help Jimmy or go over and help Steve. And all of these people, they do all the regular things, and we always say soup to nuts. So they read the meters, they do leak checks, they do line locates. A line locate is when another utility calls to ask that our line be located because they're going to work on their line. They also do what we call line patrol, where they walk the line and looking for gas leaks. There's other things that they need to do, like popping relief valves or other periodic maintenance issues that they have to take care of. And we talked about, we also had brought in some employees from Oklahoma to help with some of the periodic maintenance with Jimmy when we were having some employee issues here. So that's what those employees do on a daily basis.
Okay, so now I'm going to ask just some follow-ups to that general summary. So for purposes of the second employee, as of 2024, which I believe is the test year in this case, that employee was employed, correct?
Yes, ma'am.
And you stated you intended to fill, have you advertised for that position or attempted to fill it at this time?
We generally don't hire people in the winter because it's just not really a good practice. You want to wait until spring to hire people because otherwise, there's not a lot you can do out in the field in the winter. It's just kind of too cold. So we would wait till spring to rehire that position. And we also kind of need to be in a better financial situation.
And to that aspect of it, in a perfect world, in perfect normal financial conditions, would you anticipate paying the employee the same or approximately the same as you paid in the test year?
Yes, we do think that we would probably hire this employee in the Albany area, rather than hire another person over in eastern Kentucky. That seems like it would make a little more sense to us. Actually, you bring up a good point. One of the big things that has really impacted us is our labor costs have increased 50% since 2019. So from the end of 2019 to the end of 2024, our labor costs went up 50% with our employee count staying the same. And that was just a function of the inflation and the tight labor market that occurred during that period of time.
Did you all, and I don't recall seeing it, so I apologize if it's in there and I just missed it. Have you all done a wage study or anything like that, or is this just based on your experience and the retention of your employees?
So we have, in the past, we've done wage studies. We use ADP as our payroll service, and they have wage studies available. So we have looked at those in the past. In the current situation we're in, that those tend to lag, and so and we are historically and this Oklahoma is the second lowest wage state in the nation. I think Mississippi was first, and so just by way of example, when we first began in 2007, and we always typically hire, the employee at the bottom. At that time, in rural Oklahoma, we were paying $7.50 an hour to start. That same employee today, and so now it's 2007 to 2025, is starting at $16.50 an hour. So you can see the dramatic change in, over, not quite a 20-year period in the where the wages has more than doubled. And also, so now we're going to get into our wage, and forgive me if I'm going far afield, but our wage philosophy is we tend to pay a little less but have very high benefits. So we pay 100% of the individual's medical as well as their families, which my understanding is we're one of the last companies in the country to do that still. And then we have other benefits, and it's we believe it leads to a stable workforce. More than half of our employees, of those 40 employees, have been with our company more than 10 years. And a good portion of them have been just the whole entire time. But when you think about, not only do have our wages gone up 50%, but also our insurance costs, healthcare costs have gone up quite dramatically, as well as other insurance costs have gone up quite dramatically.
Okay, so I have some more follow-ups. You mentioned having employees from Oklahoma help out where you had the vacancy, and employees from the Tennessee portion help out. How do you all communicate within those separate entities, like on a daily basis, or, I mean, is there a consistent communication level between the separate entities?
Absolutely. Kevin Piercy is our operations manager. He works out of our Eakley, Oklahoma office, which we consider our operational headquarters. Our main construction unit is located there, and we have a meter proving facility there. And Kevin oversees the operations of all of the states that we're located in.
So I know that you don't have an office in Kentucky, correct? Like an actual location that a person could go and pay a bill?
That's correct.
Okay. So I'm just going basic question, like logistics. If there was an account held by Mary Thomas and she got her Navitas bill for the month, how would she go about, if she had questions, tracking down somebody to answer those questions and then subsequently paying the bill?
Sure. I'd have to double check, but I know in Tennessee and I know in Oklahoma, and I thought in Kentucky we have a bank that they can go to pay the bill. I need to double check that. We kind of pride ourselves on the idea of, Jimmy is, as I said, soup to nuts, and many of our customers have his cell phone number. Like, they just call, if they have an issue, they don't call into Oklahoma. They just call Jimmy direct and say, Jimmy, hey, I'm smelling gas, or I'm going to be doing an addition to my house, whatever the case may be. And in small towns, people tend to know how to get a hold of each other. In the event that maybe they're new or to the area or something, of course, obviously, our bills have phone numbers on them. Our website has phone numbers, and then of course the signage on the pipeline itself has the phone number. That phone number goes into our Eakley, Oklahoma office, and the ladies there then can dispatch information to Jimmy.
Okay. So in that scenario, let's use that scenario. In that scenario where you're talking about Jimmy helping them, obviously how does he bill those hours to reflect the work is done here in Kentucky? Okay,
so Jimmy only works in Kentucky. So 100% of his cost is directly charged. It's through a direct allocation to Kentucky. When, for instance, Kevin is an allocated employee, as are, say, for instance, the ladies in Eakley who do the billing for Kentucky. Those costs are allocated based on what's called the Atmos Kentucky method, and that method was mandated to us by the Tennessee Attorney General back in 2012.
can I stop you though?
Sure.
Because I think my question is simpler than that even. I really do just want to know, like, how those employees keep track of what jurisdiction they're doing work for.
Okay. So if you're an allocated employee, you don't keep track of hours, right? If you are Jimmy Lawson, you don't keep track of hours either because 100% of your hours go to Kentucky, so you don't need to keep track. Let's say, for instance, when Johnny Gorman and Stephen Yearwood came out to Oklahoma, from Oklahoma to Kentucky, they do a job sheet. And at the end of the year, we take those job sheets and we price those job sheets out and then charge them to the utilities that they go to.
So in that particular instance, when they came out from Oklahoma to help in Kentucky, they did job sheets, and those will be subsequently, at the end of 2025, reviewed and charged to Navitas, Kentucky.
That's correct.
And will that be at an hourly rate then, based on what they did?
Yes, so it's typically done as a daily rate, right? Because they're here, they're working all day. And so whatever equipment they might have brought out, like their pickup, or if they happen to have brought a backhoe or something with them, that's charged, the equipment's charged, and then their time is charged, and also a per diem for the lodging and such.
Okay. I may have more questions, but I'm going to move on to a different topic, if that's okay.
Sure.
It is related to the debts and notices of termination that were filed after the IC that we had. I believe they were actually filed into the record on October the 27th. Do you have those available to?
I have the,
I don't know that you'll need to refer to them, but just, if you do, let me know. I think a lot of my questions are more general with regard to I think there were two, and I'd like to start with the Clearwater Enterprises letter.
okay, sure.
Okay. As a general question, before we talk about the two letters, are these your only, is Clearwater Enterprises a natural gas supplier?
Yes.
Okay. And are Clearwater Enterprises and Petrol Energy your only natural gas suppliers?
No, there are two largest.
Okay. Can you tell us who the other two are?
We have, here in Kentucky, we have Sparta and Diversified and Columbia. Let me, Columbia may not be a supplier. They might be just a transporter. I think so I think it's Diversified and Sparta are the suppliers here in Kentucky.
Okay.
And then we have other suppliers besides Clearwater and Petrol in other jurisdictions, but I'm thinking you're not concerned with that.
Yeah. And generally, where do you all categorize, what expense account do you categorize your natural gas suppliers' expenses to?
That's going to go to one of the 800 accounts. I'm not sure which one off the top of my head, but it's going to be or that might be a 400 account. I'm sorry. That's right. It's going to be a 400 account.
So any expenses related to any of those suppliers would be logged in a 400 account?
I believe that's correct, yes.
And then how much of let's look at Clearwater Enterprises first. How much of that total amount owed in that letter is actually allocated to Navitas, Kentucky?
None of Clearwater's would be. They don't supply here in Kentucky.
Okay, so can you explain how or what the basis is for filing that letter in support of this particular motion?
Sure, it goes to the overall health of the company.
Okay. And then,
Just to be clear, essentially, especially in light of our inability to collect all of our gas costs because of the suspension of the gas, the GCA here, there was a lot of robbing Peter to pay Paul, which, we didn't expect the situation to go on that long. And so, in hindsight, perhaps we should have not put other jurisdictions in jeopardy because of our situation here in Kentucky, but that's not the path we took, so.
So, is there an update?
I'm going to go back and amend my testimony because I see I do have it would be an 800 account. So it'd be 804.15 would be the account that the gas purchases go in.
Okay, thank you. Is there an update to the letter as far as the debt due and owing with Clearwater Enterprises?
No.
Okay, they weren't one of the suppliers that you all used your own funds?
No, they were. We paid them $500,000 and we paid Petrol $250,000.
Okay, so that would be the update. Is there a new, so there's a new current balance owed
Right.
to them? Okay, and I know I haven't said it as much, but for Mr. Buckley's sake, we will ask a few follow-ups related to the specificity of what's currently due and owing. The Petrol Energy letter, is that going to be the same as the Clearwater letter then, that it's a supplier for another jurisdiction?
No, Petrol supplies gas both to Clinton County and to Johnson County.
So you've mentioned that you made a $250,000 payment to them. Do you have any idea the amount currently owed to them?
I believe it's still around $250,000.
And have they given a particular deadline that they would like to have the remaining balance?
We are currently beyond what they view our credit, our available credit to them.
Okay, and I'm not sure, how will that affect your service regarding that supplier in the coming months then?
Well, this is like the old saying that, if you owe your bank a little money, you're in trouble. But if you owe your bank a lot of money, they're in trouble. And Petrol's a pretty small company, and we owe them a lot of money. And so they are having to, I'm sure they would rather not be in this situation, but they have to work with us. And we're sensitive to their needs, but we're doing the best we can with all of our vendors.
Well, that leads me to the next one then. Sparta. There was no letter filed with regard to Sparta or any money owed to Sparta. Do you have any idea if there's any current arrearage owed to Sparta?
It's substantial. It's actually, it was Frank Cash from Sparta that called me yesterday that said he'd be watching today. I don't know what the exact number is, but it is in the neighborhood of $100,000.
And have they given you, obviously if he's watching the hearing today, have they given you a deadline for?
There, we're also trying to work with them to, get them enough money for them to continue operation, and we're all trying to get to a better place together. And winter is obviously going to be a big help, and then the outcome of both this and then the rate case itself is going to be a big help. And then also the GCAs, as we're starting to collect more, we're doing better there. So.
And then the last one, Diversified. How much, do you have any idea how much is owed to them currently?
I think it approaches about $50,000.
So there's no, based on what you've said, there's no like set monthly payments toward arrearages that Navitas must make every month. Is that correct?
So we do have a set weekly payment that we're supposed to make to Clearwater. We don't have that, or we do typically pay petrol on a weekly basis, but there's no set amount. And then like Diversified or some of the transporters, we might essentially we choose to pay them on a weekly basis or on more than a monthly basis.
Okay. Sorry, I'm trying to go through my questions because we've kind of covered some of them. And how does Navitas Kentucky get allocated its gas expense from each of these suppliers?
So gas expense is generally charged directly because it generally can be charged directly all the costs go through Navitas Utility, but so it gets allocated, but it gets allocated as we say directly. If Columbia charges $5,000 for transport, Navitas Utility charges Navitas Kentucky $5,000 for transport. There's no markup or even administrative cost associated with the allocation, if you will. And generally that is the case throughout all of our systems. The one exception is Clinton County, where the gas comes up from Deer Lodge, Tennessee, and crosses the border into Albany. That gas is allocated between Tennessee and Kentucky based on the meter readings.
And I know this seems self-explanatory now based on your response, but just to confirm, the reason the letters say Navitas Utility Corp. Then would be because the gas costs are charged to the the main company, and then you will allocate it down to Navitas, Kentucky.
Exactly.
Okay. Okay. Now, some of the loan documents would indicate that there were payments that were not made in 2025. And I guess I'm shifting gears a little bit, but it's still default debt type questions. Can you explain at what point Navitas, Kentucky would be in default on any of the loans that it currently has?
Right, so on our line of credit, so our lines of credit are with each jurisdiction. So we have a line of credit for Kentucky. Although, money is fungible, right? So, but the Kentucky line of credit is in technical default because it did not cycle in 2025. And by cycle means it needs to be paid down to zero. So it was not paid down to zero, which typically happens in the spring. So it's in technical default. The system loans in Kentucky, of which there are 3, those have a technical default associated with them in that our current ratio is not at the required amount.
Okay, can I stop you before you get too far down?
Sure.
Okay. So just so I'm clear, the lines of credits are assigned to each jurisdictional utility. Like Oklahoma has their own.
Yes.
But you do maybe use one for another jurisdiction and vice versa.
They're pretty much all fully drawn right now.
Okay. And then you mentioned that you have 3 system loans, correct?
Yes, for Kentucky, yes.
And you technically are not in compliance with the debt covenants due to the ratio that you're required to keep. What is that ratio?
So the current ratio is you take your current assets and you divide it by your current liabilities, and we're supposed to be at 1.25, and we are substantially under 1.
Do you recall maybe when the last time that you were close to that ratio?
Probably 2022.
And have any of the lenders sent letters or mentioned that?
Our main lender, which is called Bank 7, they're out of Oklahoma City, they have, I regularly go see them, generally in person, and they have expressed substantial concern.
Okay. So, is there a minimum payment that you are expected to make to them every month right now? That they've said, you've got to do this?
So the system loans, generally, we've been able to keep up, although I know our 2 biggest loans, which are one in Oklahoma and one here in Kentucky, we have been more than 30 days arrears on those loans. The lines of credit, those renew annually, and they are putting pressure on us to improve our financial situation. But I keep them informed regularly of these goings on, and when I can show them, hey, we have this, for example, when we did the rate case in the Oklahoma jurisdiction, and I could show them, oh, look, see, we're going to have these rates go into effect, and then there was a second phase where we phased in a second increase. they can see that trajectory, they give me some more leeway or more rope to hang myself with, one of the two.
Well, so, you mentioned the 30 days late. And then there's some, it appears, based on the payments that have been made, that are only like 1 or 2 days late, and they result in late payment fees. Can you talk a little bit about is that an automatic payment that comes out, or is that a decision that the company makes to pay on a certain date?
I'm literally every single day, I am looking at how much monies came in that day and who we can pay every day. I understand the late payments are accruing, but that's something that in the end, once we kind of right the ship, we could probably go back and negotiate some of those off. But right now, given our precarious situation, I can't argue with them about it, right? It's like I can't spend any chips because I don't have any left yet. I need to earn some.
Did you all include the late payment fees and interest that occurred during the test year in the revenue requirement calculation?
I don't know. I don't think so. I'd have to I'd have to check into that.
So we can follow up with the post-hearing data
Yeah.
request just to confirm, okay. How generally do you all make the decision? And you mentioned it was like, right now it's a day-to-day decision, but in the test year, so looking back last year, and maybe it was true last year, but looking back last year, how did you all make the decision to pay certain debts, whether it be line of credit or loan payments? How generally have you all made that decision in the past?
So, generally speaking, our system debt is due on the 15th, and then there's a 10-day window in which we can pay it. We typically pay all the small ones. All the lines of credit have an interest due on a monthly basis. Those are always paid. We cannot risk having them freeze our line of credit. So those are always paid. The bank notes, the system loans, we pay those, the smallest ones first, because they're the easiest ones to deal with. And the large Kentucky and the large Oklahoma are generally the ones paid last, and maybe even held over a month.
Okay. I don't know if you all have done this, considering the circumstances for this hearing, but generally companies have business plans. They look out a year ahead, 5 years ahead, like a 10-year plan. We're here on an emergency request. Does Navitas have a plan for, you mentioned righting the ship? As of today, does Navitas have a plan in place that's either written down or just between you and your business partners that would help right the ship?
Yes, I mean this is the plan, right? Filing the rate case in Kentucky is the plan. We saw a dramatic increase in inflation beginning in 2021, 2022, and 2023. Huge increases in inflation. and the cost of, and permanent cost increases. Now, when I tell people that the second worst thing that can happen to a utility is inflation. First worst thing being some sort of a catastrophe, whether it be man-made or otherwise. But the second worst thing is inflation. And the reason is we have no pricing power, right? It takes 2 years, generally speaking, to raise prices in a utility. And you'll probably, let me explain. First, you have to recognize the need to raise prices. So you have to recognize that there's inflation or some other factor that needs to be addressed and a rate case needs to be done. Then you've got to wait till the end of the year, because as a small utility, we cannot do a rate case across the end of an accounting period. We tried it once, it's a disaster, right? You must wait till the year end. Then once the year, so you recognize it, the year ends, then you do your closing, then you do your rate case, you file your rate case, and now you have, once the rate case is accepted, generally there's a statutory 180 days, but it always goes longer. And so by the time, from the recognition that you need to do one till the actual implementation of rates is 2 years. And if you have inflation, as a utility, as a gas utility, generally our weighted average cost of capital is 9%. And by the time you take a 15% return on equity and a 6% return on debt, you're going to get a 9% weighted average cost of capital. Well, if inflation is 20% and I'm earning 9%, it doesn't take long, to figure out that you're losing money. And so, so what, in addition to doing rate cases, right, that the primary, we have two ways. We can either grow, which we've done a lot of, right, which is why we didn't need to do rate cases, or we can do rate cases. Now, in the interim, we can find ways to cut costs, right? We can reduce our employee count in Kentucky from 2 to 1. We can, try to find other ways to cut costs, delay purchases of new vehicles, delay certain, maintenance projects or line replacement projects. So there are ways that we have been able to cut costs. But really, it's all about doing a rate case.
So you obviously mentioned it's been 4 decades. It's been a long time, basically not ever since you've taken over parts of the system. When was the last time, you mentioned an Oklahoma rate case, when was that? The most recent one?
That was used at test case year 2022. The rate case was filed in 23, and the rates were implemented in 24 and 25.
And then what about in Tennessee? Have you done one
In
lately?
Tennessee, the last rate case, I think it was test case year 2018, with the case filed in 2019 and the rates implemented about that same time. I'd have to double check on that, but it was around that time frame.
Okay.
And in Texas, we don't have to do rate cases because we don't have any residential customers. So we're allowed to negotiate our rates with our commercial customers.
Okay. So I have some questions about the general ledger, and I was going to try to stay out of confidential session, but obviously Navitas has asked for the general ledger in its entirety be held confidential. So I would like to ask some like general, if that's okay.
That's fine.
And then if we have I do have some specific questions, which, I mean, I think we'll have to go into confidential session
problem.
for those.
Just let me know.
With regard to the general ledger, how do you generally record the items in your general ledger? Like the one that you've provided, does that look like what you use on a daily basis?
The general ledger we provided came out of our QuickBooks. It's generated by our QuickBooks software. So Carlos Gonzalez, who I think has testified here before, and has certainly submitted data requests. He is our director of accounting. Sarah Espinosa. I'm a little embarrassed. I can't remember her last name. Sarah is our. She generally puts in all of the accounts payable except for gas costs. Julie Loving puts in all the gas cost vendors associated with the GCA. There's a separate billing system. It's called Continental. It does all of our essentially accounts receivable billing. That data is then transferred to QuickBooks monthly. So all of our accounting is done in QuickBooks, and then that's the report that was generated to you.
Do you keep each jurisdictional?
Yes.
Okay, thank you. And then I think we will have to go into confidential session because we do have some questions.
Ready now?
Yes, please.
Candace, let's go into confidential session. public record, I should say. All right, we're back on public.
Okay, thank you. Mr. Hartline, staff would like to get a better understanding of what your monthly bills that you absolutely must pay on behalf of Navitas, Kentucky. And it doesn't, without obviously a office front here, you don't have the normal basic utilities per month. And you've mentioned a few of your debt service obligations. Besides salaries, benefits, and insurance, what other ongoing monthly obligations does Navitas, Kentucky have that we may not have talked about yet?
So I think there was an exhibit we filed, C-1, and I think that might have been in the informal conference. I'm not sure where it was filed. And in that I talk about, I have a very simple breakdown. So, and I did it annually. So our annual debt service for Kentucky is $297,220. So roughly speaking, $300,000, so $50,000 a month. Then our annual property tax in Kentucky is around $24,000, so that's $2,000 a month. We have direct costs of $204,644. That's Jimmy Lawson, and that would have been because that was the test case year. That would have been the two employees' costs. Then we have allocated costs of $778,000, and that's for Kentucky's share of, for example, supervision and billing and insurance. So I'm talking about general liability insurance. The 900 account allocations.
Mr. Hartline, did you say those were annual costs or monthly costs?
Annual.
And that's $700,000 for liability insurance?
Not just, that's the total allocation. So that's the allocated costs. I mean, it would start with, I'm allocated. Kevin Piercy, who I mentioned, would have an allocation. The billing ladies in Eakley would be allocated partially to Kentucky. Our general liability insurance is something like $100,000 a year, and so Kentucky's going to end up with somewhere between 20 and 25% of that being allocated to Kentucky, because it ends up being about that percentage of our operation through that Atmos method that I talked about.
Okay, very well. Sorry to interrupt Carol's train of thought. I just wanted to get clear whether it was monthly or annual.
Well, I think following up on your question, I think staff was going to follow up with a post-hearing data request to get a monthly breakdown. And if something is paid annually, if you could note that as well. So if it's only an annual expense instead of on a monthly basis, that would be helpful. Especially since this is an emergency rate relief hearing instead of a regular one. With regard, I'm going to shift gears again to the annual report. I know that Navitas, Kentucky files their annual report, and it was an issue in the last rate filing. And Mr. Hartline, could you tell us a little bit about what steps you've taken to ensure that that 2023 annual report reflects accurate information now, as of today?
Yes, so that entire report filing process is being completely revamped in 2026. The person who was performing that task is retiring, and so what we're doing is one of that person's duties was the GCA filing, in part, and that's going to go to another individual in Oklahoma. And then the report writing, or the report filing portion of that person's duties, we have an individual who does our DIMP filings. Do you know what DIMP is? Okay, so he does a lot of our DIMP filings and other filings associated with our operations. He also calculates our line loss, and that individual is going to take over the report filing for both our state jurisdictional reports and our federal jurisdictional reports.
So I know that you all attempted to file a corrected annual report in the case file of the last ARF case. Was that ever filed in the other, through our filing system, so that it would show up on the website? Or do you know?
I believe so. I mean, as you recall, you were very gracious and pointed out an error in the current filing, and I think we've corrected that as well. So I think we've corrected both the current filing as well as the prior year filing.
So you mentioned that the person who had been doing those filings was retiring. Can you talk a little bit about what information they use to compile the numbers that are used in the annual report, or do you know?
Sure. A lot of the information is going to come out of the Continental Billing System because it has to do with customer data. And that's, I should point out that the position is being, that reporting position is being moved from California to Oklahoma because it will then be proximate to the people most familiar with our billing system. And so I think that the communication will aid in getting the information correct. There's some financial portions of that as well, and that comes out of our QuickBooks. And I don't know if you're aware, but Carlos Gonzalez, our Director of Accounting, moved from California to Oklahoma in July, again to put him more proximate to our operations. And we think that, well, we've already seen benefits from that. And so we're by consolidating all of this into the location where a lot of it happens, we think that it's going to lend itself to being a better situation.
Is there a second person or another person in, well, I guess now it sounds like Oklahoma, who would review the information compiled for the annual report, or is that going to be changed part of the change going forward?
Right, so we're having Ron Cummingdeer, who is our regulatory counsel in Oklahoma, will be reviewing a portion of those reports. And then we haven't gotten confirmation on this yet, but we've asked Jerry Foreman, who does our he is a person who he does the review of the DIMP filing. He also is the person who writes our emergency plan and our operations manual. And Jerry is, he's out of Nashville or Franklin, but he's going to be reviewing the Tennessee and the Kentucky report. I always say to people, I speak English, but I don't speak Tennessean, and so I think it's better to have somebody who's more familiar. And also, I will say that Jerry is one of those rare persons who just thoroughly enjoys reading federal regulations and knows it backwards and forwards, and so we're hopeful that he'll agree to take on that role of reviewing those reports.
So, in this particular case, in the preparation of filing this application, how did you all utilize the 2024 annual report? Or did you?
Generally speaking, I think we always go back to the source material, and that's going to be QuickBooks and Continental. So we're generally going back to that material to do our rate case filings.
Okay. I'm going to shift gears again to the schedule of adjusted operations generally. So I don't necessarily think you need to have it in front of you, but the schedule of adjusted operations was filed as attachment 4 to the application, and I believe specifically at adjustment 5 it states that there was an adjustment made for a 77% increase in gas purchase expenses from 2024 second quarter average to the first half of 2025. Can you explain a little bit about why this adjustment was made?
So I actually remember this because I was looking at it, and I thought it was, it's like, what you eliminate gas costs. Why are you making this change? I was questioning Carlos, and his response was that because that's what's required, that this is, you're supposed to do this. And I looked at it very closely, and I said, but this isn't increasing our required revenue, is it? And he assured me that it was not increasing our required revenue, and we went through the calculation, and I was satisfied that it was not increasing our required revenue.
So, I guess based on your all's conversations, you came to the conclusion that this was not related to purchase gas expense in the way that you're describing is recovered through the PGAs.
I think that there might be a couple different things going on here. The test case year gas costs were some number, $634,000. The projected gas costs for 2025 are apparently, he calculated 1.1 million. And that just reflects a change in the cost of gas. My point to him was, given that gas is eliminated as part of your, why even make the adjustment, right? Because you're just going to add it and take it back out. And he said that's what the instructions tell him to do. So, I guess part of the answer to your question is, at least from our projection standpoint, gas costs did increase significantly. And that's reflective of the idea that in 2024, gas was like 250 an MCF, and I'm talking Henry Hub, and now it's like today it was 508. So gas costs are significantly higher in 2025 versus the test case year. So, yeah, just to be clear, there's two issues. Gas costs are higher, so our GCA will be higher. I'm not sure why it needs to be adjusted, given that you just take the adjustment right back out. But so.
I guess that's my next question, because it doesn't appear to be, so theoretically, taking what you've said, then there would be that corresponding adjustment for revenues. But there doesn't appear to be a corresponding adjustment made for there's no adjustment made for any of the revenue categories. Can you explain why there isn't that corresponding adjustment?
And that was my question to him exactly. And he said, because there's no instructions to do that. And then, again, I went through the calculations several times to assure myself that the revenue requirement increase on the our Form 1 is not impacted by the gas production expense on the statement of adjusted operations.
So I think that staff will be following up with a post-hearing data request related to that corresponding adjustment, just to confirm that any gas costs recovered through the PGA aren't included in the revenue requirement.
Right.
Mariah, when you get to a decent stopping point or pausing point, we do need to take a little break.
Well, then we can stop now.
Is this
Yeah.
one?
Yep.
I was waiting for you to maybe be ready for the transition. Let's take 15 minutes.
Okay.
Thank you.
2025-00332. And staff, please continue.
Okay, thank you. Okay, Mr. Hartline, I am going to shift gears again a little bit to the revenue requirement calculation generally. I believe in the revenue requirement calculation that you all tendered with your application, you utilize the operating ratio method to determine the working cash capital portion of the revenue requirement. Is there some reason you chose that method instead of the debt service method?
I guess I'm not familiar with, I thought that the ARF, you had to use the operating ratio to do the ARF.
Okay, so if staff included some DR request related to a different type of calculation and provided some guidance, would you all be able to provide the information and numbers related? It's more of a calculation related to your cash required to service your debt as part of that calculation. Would you all be able to do that?
Sure, yes.
Then, let's see. There are a few other questions that staff had related to the 137,000. And I know you talked a little bit about the breakdown of the 137,000. And is there, you would agree, based on the information you filed so far, that Navitas, Kentucky obviously needs more than that as part of its revenue requirement?
Yes,
Or I guess more than that increase to its revenue requirement?
yes.
Okay. As to the 137,000, is that increase, when broken up by the month, enough to get you through the next 4 or 5 months?
I believe so. As I mentioned, most of that 137,000 will probably come in January, February, and March, assuming we can get an order out, and so on and so forth.
Okay. My next question relates more to the tariff and the calculation of the non-recurring charges. I believe that in response to our first DR, you provided it to item 3 in Excel, and it had the number of instances or occurrences for the insufficient check charge. Are you familiar with that response?
Yes.
Okay. And I know you sponsored the filing of the tariff and signed on to that. And you're familiar with the amount that's set forth in the tariff for that charge?
Generally, yes.
Okay. And the amount provided in the Excel to item 3 was a total of $400 was collected, and there were 8 occurrences, correct?
Yes.
Okay. But 8 times the 15 equals $120, not $400. So can you tell us explain the discrepancy there?
I'll have to
Post here.
review it and
Okay.
submit it.
And then, let me see if I've got. Okay. The next question I have is related to the cost allocation manual. And I believe that you all filed the cost allocation manual as part of the application. It was a separate exhibit. And then you provided a response to staff's first request, item 11. And in item 11, and I'll give you a minute if you don't want to.
Go ahead.
So in item 11, you reference, and I will try to keep this as generic as possible because your council did ask for confidential treatment on this. It references an account 700, but there is no account 700 category in your cost allocation manual. Can you explain that discrepancy? And if you don't know, that's okay. We can always ask that one in a post-hearing data request as well.
Yeah, we'll need to do that as a follow-up.
Okay. And then my last line of questioning, I think, relates to the information filed on October the 27th related to the billing analysis. I think that was attachment 6. And I'll give you a minute to.
I'm sorry, what is it?
Attachment 6, the billing analysis. And then there's also, my question relates to that as well as the filing for the GCR in case 25 through 16. If you go to the Excel file for that one, do you have that with you by any chance?
I don't.
Okay. We will follow up with those questions in a post-hearing DR. And I think that is all that staff actually has.
Oh, okay. Mr. Wood?
Mr. Hartline, did you say that there are 5,000 total gas customers for Navitas across the country
Yes, sir.
generally, and that Kentucky has 700 of those
That's correct.
approximately? And by my math, that's 14%. It seemed like you testified earlier that some of the costs, or I don't know if it's all the costs or which ones exactly, but there were 20 to 25% of the costs being allocated to Kentucky customers. And then I think you spoke about an Atmos method, and I just wanted to ask if that was true, if you are allocating to 20 to 25% of the cost to Kentucky customers, but if it's only 14%, does that seem inequitable to you?
So the way the Atmos method works is you take percentage of customers, as you've described, and that becomes 50%. So you take the 14% times 50%, that'd be 7. And then you take net plant or plant in service, and you allocate and you multiply that by 50%. And so while Kentucky has, as you rightly point out, a smaller portion of customers, it has a much larger portion of plant. And my understanding is that the theory behind it is that you're going to spend more time where you have more plant. because you have more investment in that location. And that's how you get to the 21%. And we recalculate that each year at the beginning of the year based on the customer count from the prior year and the changes in net plant.
Did the pipeline that you took to your industrial customer spike the percentage that
Absolutely.
residential customers are paying?
Yes, sir. Well, I guess you'd have to do an analysis to determine if the residential customers are subsidizing that. It's entirely possible that the revenue generated off of the one industrial customer exceeds the increase in allocation.
Do you know how your proposed rates stack up with neighboring counties and neighboring communities in terms of the customer charge and the cost per 1,000 cubic feet?
So I don't have the numbers exactly, but I am aware that even at phase 9, our rates at phase 9 would not necessarily be the highest rates charged in Kentucky, even, versus today's folks. I also am aware that, for example, this is a 77% increase overall on our required revenue, and essentially, it's been since at least 2013 test case year. Kentucky Frontier, my understanding is, just came in and filed a case. They're asking for a 35% increase, and they had a rate case in 2017, I think. So, and I even think that their customer charge that they're asking for may be more than what we're asking for ultimately. So I don't think we're the highest.
I've been in an all-electric house for 20 years, and so I'm refamiliarizing myself with gas rates in Kentucky since I got my appointment. And maybe I'm showing my age, but there was a day when $12 was a lot for 1,000 cubic feet of gas, and your requested rates, I think, are $14.90. And so maybe that's reflected all across the state. I'm not sure, but I just wanted to ask you about it and see where you thought that you compared with other gas companies.
Right. Just for your, so gas is still, when you make the comparison of natural gas to electricity, you take your cost per kilowatt hour and you multiply it by 29.4, and that will give you the equivalent energy, and so that's what you should be paying. If your gas cost is less than your kilowatt times 29.4, then gas would be cheaper than electricity.
So if your electric rate is 11 cents per kilowatt hour, you would take 11 cents times 29.4?
Yeah, exactly.
Okay.
And so you'd be at like roughly $3 per CCF, which is about $30 an MCF, and I think we're still under that. And good for you for having 11 cent electricity. I haven't seen 11 cent electricity in about a decade.
All right, very well, thank you.
Commissioner Reagan?
Just a couple questions. You were here a few months ago. Little bit in the same situation, but my understanding is progress is being made, that you've been working with the team. Do you do benchmarking with other companies that are similarly situated with their benefits, salary, all of that?
It comes up in the rate cases, so we do get some feedback from jurisdictions on where we stand with regard to those sorts of things. Generally speaking, we're always the lagger in terms of, and it has to do with the rural nature of where we are. If you compare us to a major utility, they're paying their people way more than we're paying our people. Even when you monetize the benefits, and they're still paying their people a lot more than we pay our people.
I'm trying to understand, and I think you are correct, that you have to be one of the last people paying benefits to family members. Going forward, have you thought about whether or not that's sustainable? Because for most companies, paying that health care moving forward, not for the individual, but for their family, has pretty much been discontinued.
Sure. It has to do with, we monetize our benefits. And so the one I'm most familiar with, so for instance, I just saw this number because we had an employee who was trying to be enticed away. This was in Oklahoma, and one of the major utilities said, well, we'll start you at $28.35 an hour. And this employee was making something like $20 an hour cash wage from us, and they would go to $28.35 at this other major utility. But they would have to contribute to their health care, and that contribution is like $600 a month, and so that's about $3 an hour, right? And then we also provide our employees, our employees that have vehicles, the vehicle is allowed for personal use. Now, we tell them you can't tow the boat to the lake on the weekend, but you need to pick your kid up from school, you need to run to the grocery store, it's perfectly fine. And again, this has to do with the rural nature, right? We can't have employees going all the way home to get their personal vehicle to then go back to the school to pick their kid up, right? That just doesn't make any sense because of the distances that are so great. And the other thing is we don't want employees to have to come to a central location to pick up a vehicle to then go back out past their house, because then they've just spent well over a half hour probably, of time that they didn't need to spend. So when we monetize all of our benefits, we're trying to make sure that, are we getting back to where we would otherwise be? And we think about this issue because essentially the benefits become as almost like a set of golden handcuffs, right? Mm-hmm. It's like, they're going to pay me a lot more cash, but boy, I got good health care, good benefits from this other company. We've been very, very successful keeping people long term. It's hard to hire young people, but the people who are real stable and they have a family or whatever, it's very hard to get a good job in rural areas, and so that's the advantage we use.
And I agree, the healthcare piece is important, but is it sustainable moving forward? And I don't know, it's probably something that we can talk about, but to pay for the family.
Right. So this very issue came up in another jurisdiction, as we pointed out to them, and they agreed. Well, okay, because they actually wanted to take it away. They said, this isn't appropriate. I said, okay, well, if you take it away, how much more are you going to have to pay the employee? And we were able to demonstrate that it makes more, they'd actually have to increase rates more if they took the benefit away, because we'd have to pay the employee cash in order to pay that cost. And if you think about it, even if the cost is tax deductible, there's still like a company side of the Social Security wages and things like that. So for every dollar in benefit I take away, it ends up, if I have to remonetize it, it costs $1.15. And so we were able to convince them that it made more sense to allow us to continue in that fashion, even though it is not the norm.
Okay, thank you.
Along that same line, just following up, you said that you were able to demonstrate that it would cost more to remove these benefits and pay cash. Demonstrated to whom? Was it a PSC case or another case?
This has come up both in the Oklahoma and the Tennessee jurisdictions.
And in both those, you're continuing to pay the family?
Yes, yeah.
Okay. That's all I got.
Did you ever poll the employees to see if that really matters to them, or?
So we know, we're a male-weighted industry, right? Mm-hmm. We know that having the healthcare benefits, that's a wife issue. And the wives are the ones that convince, no, you're not moving, you're not changing companies, you're staying with Navitas, and that's that. And we see evidence of that.
You were talking earlier about the $750,000 that was injected into the company in October. Was that by your corporate parent company?
Mr. Varner put that in.
Just a shareholder, or the?
Myself and Mr. Varner own the company. That's all it is.
So this was like a loan?
He put it in as a loan, yes.
Do you have set repayment terms?
He's desirous of getting his money back, but other than that, it's a little, we're supposed to pay interest on it, but we don't have the money to.
You were talking about how you use Oklahoma employees to fill in Kentucky. Does that mean that includes travel and lodging expenses, or are they working remotely from Oklahoma?
Oh, so when they come out, generally they drive, because generally speaking, they're going to bring out either meters or equipment or something, and then take back other meters or equipment with them, and that drive, it takes a day. So there's an extra day of travel associated with that.
Is it still more efficient to pay travel for those employees than to hire locally? Or is it just an issue of being able to find people to hire locally?
So ideally, we'll go back to having 2 employees, right? Like for instance, right now, Jimmy Lawson's running a tremendous amount of overtime to keep up with the workload, and while that's great for him financially, long term, it wears on an employee, and the money doesn't become worth it after a while, and so. We anticipate that we'll be hiring another person to lighten that workload.
Is Jimmy hourly or salary?
He's hourly.
Okay, so it's also time and a half.
Yes.
Okay.
Yeah.
And then you were mentioning the,
Just to finish that thought,
sure,
I'm
yeah.
sorry. In order to work on the pipeline, you have to be OQ qualified. And so while some of Tim Hull's personnel are OQ qualified, on certain things, they might not have the particular like say pop and relief valves or something. They don't actually have that qualification. And so the employees that we bring out have all the qualifications they need, where you can't necessarily hire that from a contractor.
okay. Is that a class that takes a while or a certification?
Yeah, it's a periodic certification that you have to get.
You were talking about the money from Keystone, the $500,000, that's a collateral against that loan, to build the pipeline. And you have to keep that separate, that's restricted cash, you can't spend it. Is it in an interest-bearing account?
Yes. And that interest does reflect into Navitas KY NG. There's an annual interest income.
Okay.
Yeah.
Staff was asking you about the actual non-negotiable must-pay monthly bills, and it was mentioned that there's no Kentucky office, so you don't have utilities. But do you pay a portion, or does the Kentucky company pay a portion of expenses like utilities, rent, leasing, payments, things like that, of the Oklahoma office? Is that part of the
Yes.
25%?
Yes.
And then finally, I guess, just sort of an overall, more general question. This emergency motion will generate about $137,000, if I understand correctly. Is it enough? And can you get it soon enough for it to actually help? Will it come out of next month's bills?
So if we can have an order out by the end of the year, then we can begin charging it in January. So it'd be the February 7th billing for January usage. The vast majority of that, $137,000, is going to be earned in typically, there's like a 5-month window that begins about mid-November and ends mid-April. That's when the bulk of the revenue is earned. And so we will hit 60-70% of that window. So a good portion, I don't know the exact number, but it could be that $100,000 is generated through that just right in that first quarter. And so, as I mentioned earlier, we do need the money. Absolutely, we do need the money. But more importantly, we need to be able to point to it and show, we need to restore confidence in our banks and in our vendors that the process is working.
Okay, and that was going to be my next question. If it's dually helpful in that it demonstrates for your lenders and vendors.
Need a project timeline kind of for them.
Right.
Yeah.
Yes.
All right, anything further, Commissioner Webb?
Nope.
Okay, any redirect? All right, in that case, we don't need recross. Anything further before we do the housekeeping wrap-up stuff? All right, any reason this witness couldn't be excused? All right, sir, you may step down, thank you very much. And, let's see, if we get a written summary of any post-hearing data requests out by December 8th, could you respond by the 12th? I know we're in a hurry, that's not much time, but.
Absolutely. I
Okay.
understand that we're on a tight timeline, so we'll accommodate whatever's conducive to getting that order.
Yeah, and do your best, and anything you can't get out, get us everything you can, and then let us know when we get the rest, if all of it can't be done by the 12th. Virtual informal conference on December 11th. Would that work for you, council? Okay, at 11 a.m. to discuss the DRs? Okay. And then we'll need to get a final order out by Christmas Eve on December 23rd. Do you know if you plan to do a brief? Would you like the opportunity to brief the issues?
I don't think I think resting on the motion itself, as well as the testimony here today, and the data request response
Okay.
should be sufficient. If the commission feels a brief is,
Well, we don't think we have time. We generally offer the opportunity, but,
well, I appreciate it. I think that we'll have enough to do. I agree.
all right. And then we've already dealt with confidential matter. I don't think there's any exhibits we need to deal with. All right, anything further? And in that case, we'll be adjourned.